In this video we are going to talk about the dividend snowball effect. So before starting, please like this video and subscribe to this channel for our future updates. Compound interest is interest earned on prior interest. This cycle increases interest and account balances exponentially. The snowball effect occurs when a small snowball rolls down a hill and collects snow. While rolling downhill, the snowball's mass increases at a consistent rate. Because the snow collected on earlier revolutions now contacts the ground and picks up snow on top of the original snow on the ball, the bigger it becomes, the more snow it gains per revolution. These high-quality dividend growth stocks, such as Dividend Aristocrats and Dividend Kings, have boosted dividends for over 25 and 50 years, respectively. This video demonstrates how to use the snowball effect to expand your wealth and income by investing in outstanding companies. They can be obtained anywhere, but a good place to start is with stocks like the one shown in this video. A practical illustration. Compound interest is, without a doubt, the most potent wealth creation generator on the planet. Albert Einstein is said to have referred to it as the eighth wonder of the world. As an example, consider a $100 loan with a 5% annual compounded interest rate. You would earn 5% on your $100 investment in the first year, leaving you with $105 at the start of the second year. However, in year 2, we are now receiving 5% on $105, resulting in a total interest income of $5.25 for the year. In year 3, we'd receive 5% on $110.25, for a total of $5.5125 in interest, and so on. Your $100 will have increased to $265.33 over the course of 20 years. Your investment would have only risen to $200 if it hadn't compounded and instead been paid a consistent $5 every year. As you can see, compounding can quickly lead to extraordinary results, with compounding increasing profits by 65.3% over a 20-year period in this case. Applying the snowball effect. Now that you are aware of the benefits of the snowball effect, how can you use it to compound your investments? There is no need to look any further than Warren Buffett and Charlie Munger, two of the world's greatest investors who have ever lived. According to Warren Buffett, investing is just picking good stocks at favorable times and holding them for the long term. This seemingly obvious statement contains three important investing principles: having the patience to allow the snowball effect to work for you, having the discipline to stick to your investment strategy, and having the discipline to stick to your investment strategy. Long-term compounders are difficult to identify, but they always have high returns on equity and substantial competitive advantages that allow them to sustain high returns on equity for long periods of time. Weighing in at a whopping, as Charlene Munger states in the quotes below. 1. Return on equity is vital since it is the single most essential determinant in determining long-term investment returns. Long-term, it's difficult for a stock to outperform the business it represents. Even if you acquired it at a tremendous discount, a 6% return on capital over 40 years is still a 6% return. A business that earns 18% on capital over 20 or 30 years is a winner. You will miss out on the full benefits of compounding if you routinely trade in and out of equities due to their loss of competitive advantages, and consequently their capacity to compound at attractive rates. If you buy something that compounds for 30 years at 15% per year, and pay 135% tax at the end, you wind up with 13.3% per year after taxes. In contrast, if you bought the identical investment and had to pay 35% annual taxes on it, your return would be 15% minus 35% of 15%, or 9.75% compounded. That's a 3.5% difference. What 3.5% does to figures over 30 years is simply eye-opening. Snowball effect examples. In the financial world, dividend growth companies are defined as stocks that have long-term competitive advantages that allow them to compound their equity at high rates of return over lengthy periods of time. These are stocks that have a history of not only providing investors with additional cash flow year after year, but also increasing the amount of cash flow sent to investors year after year. This has the effect of creating a double compounding effect, which results in an exponentially expanding stream of dividend payments for shareholders. In this scenario, the investor's yield on cost, i.e., the amount of dividends received in relation to the amount of money initially invested in each share increases year after year, which, as we will see in the following examples, leads to some spectacular wealth-building results over a long period of time. 5. Coca-Cola. CocaCola KO is a perfect example of a long-term compounder with long-term competitive advantages that has resulted in exponential profits for long-term investors. It has over 500 unique non-alcoholic brands that it owns or licenses. Since its foundation in 1886, the company has expanded to more than 200 countries, with its brands accounting for around 2 billion servings of beverages each day and generating roughly $35 billion in annual revenue. It has established a strong and loyal following among consumers thanks to its powerful name brand and exquisite tasting drinks, allowing it to charge higher prices and multiply investor equity at double-digit rates over time. It's also a fantastic dividend growth stock, with a 2,360% increase in dividend cash distribution per share. 4. Lowe's Companies. Another excellent example of this type of investment is Lowe's. It was established in 1946 and has its headquarters in Mooresville, North Carolina. Lowe's is a home improvement and hardware retailer with over 2,000 locations in the United States and Canada. As the second largest home improvement retailer in the United States, it has benefited from the long-term competitive advantages of economies of scale and customer loyalty, which have enabled it to generate double-digit annualized returns for investors over the past several decades, with the company's stock price following an exponential growth curve that is once again distinctly upward trending. Indeed, it is a phenomenal dividend growth investment, with investors seeing their yield on cost increase by an amazing 18,870% since the company's inception. 3. McDonald's. Following that, we have McDonald's MCD, which is the world's largest publicly traded restaurant corporation. Because of the long-term competitive advantages provided by its great brand name, economies of scale, and extremely profitable real estate-focused franchising model, the company has been able to compound shareholder value for more than 7 decades. 2. Johnson Johnson. For the fourth case in point, consider Johnson Johnson JNJ, which is one of the world's largest healthcare products and pharmaceutical corporations. It was established in 1886 and now employs more than 125,000 people in over 100 countries around the world. Having annual sales in excess of $81 billion, the company benefits from economies of scale, a broad range of product offerings, extensive intellectual property rights, and significant investments in research and development, all of which have enabled it to continuously compound wealth at high rates for investors over the long term. 1. Federal Realty Investment Trust. Last but not least, Federal Realty Investment Trust, FRT, a well-known retail real estate investment trust, will be discussed. Since its founding in 1962, the trust has concentrated its operations in high-income, densely populated coastal markets in the United States, allowing it to charge higher rents per square foot than its competitors. The fact that it is one of the largest real estate investment trusts in the United States has enabled it to leverage its well-located and high-quality real estate, as well as its economies of scale, to gain a sustainable competitive advantage over its competitors. Investor takeaway. Each of these examples demonstrates that long-term wealth compounders can come in a variety of shapes and sizes. They can be a beverage firm, a home improvement store, a fast food chain, a healthcare or pharmaceutical corporation, or a real estate investment trust, among other things. At the end of the day, the business sector itself is irrelevant. Importantly, the company must have long-term competitive advantages that allow it to compound wealth at high rates on a consistent basis over an extended period of time, as opposed to short-term competitive advantages. In addition, it is critical for you, the investor, to have the patience to hold on to these compounding machines through the ups and downs of the market, allowing the snowball effect to take its full effect and produce long-term wealth for your portfolio of investments. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us. The Dividend Snowball Effect.